Thank you everyone so much for coming, and thank you everyone for coming to this session. I think you all made a very sensible choice. This I think is going to be the most compelling session of them all. Greg, thank you so very much for coming. I'm personally very interested in this subject, so I couldn't be more thrilled about having this opportunity to speak to you. We're a fairly small group here, so I encourage people to ask questions. I know if I was on the other side, I would have plenty of questions, so I want people to participate. And so with that, I'm just going to introduce Greg, and I don't want to sell him short, so I'm going to give the proper introduction. So Greg is a special writer at the Wall Street Journal. He's a 20-year veteran and 3-time winner of the Gerald Loeb Award, the highest honor in business journalism. He is the author of The Frackers, the outrageous inside story of billionaire wildcatters. That was a national bestseller among the best books of 2014 by the Financial Times and Forbes magazine. And he's also the author of The Greatest Trade Ever, the behind-the-scenes story of how John Paulson defied Wall Street and made financial history. And that was a New York Times and Wall Street Journal bestseller published in 2010.
You don't have to go.
I mean, for those who don't know, they should know who you are. So great. So your latest book is about Jim Simons, and maybe I'm assuming most people in the audience know who Jim Simons is, but for those who don't, who's Jim Simons? Why should we care?
Sure. And thanks for everyone's attention, and thanks for the invitation to come. So I've written a book which is out there called The Man Who Solved the Market. And it's about Jim Simons. It's mostly about his firm. It's a really unique and fascinating firm. Raise your hand if you've read the book already, just so I know. Okay, we got a one person, but a couple people. But I'll assume most people have not, which is helpful to know. So basically, Jim Simons is arguably the greatest investor, trader. It's hard to define him because the holding period of his firm, Renaissance Technologies, is so short. It's about a 2-day on average holding period. I just call him the greatest moneymaker in modern financial history. And why do I say that? It's because they have returns in their key fund. It's called the Medallion Fund. I'm assuming half the people are very familiar with Simons and Medallion and Quant investing. Other people probably not. So forgive me if I offend either one or insult either group. It's arguably, it's the greatest investment fund in history because they've had, since 1988, 66% returns per year before fees, and 39% after fees, of which are now 5 and 44. So pretty high fees. And they've done it with a unique approach. They use computer programs, algorithms. They were digesting big data before Mark Zuckerberg was finished with grade school. So in many ways, they're pioneers. They are the ones who proved you can beat the market using algorithms and models, mathematics, as opposed to instinct and intuition and judgment. And as we all know, that's where the industry is shifting. So forever it was sort of the Peter Lynch approach. Hey, my wife came home with some new pantyhose and she seems to like them, so I'm gonna go buy the stock, and that's how he made a lot of money with legs back in the 70s, I think, or maybe 80s. I write about it in the book a little bit. And now things are shifting, so it's just harder to be a fundamental active investor today. Some people are moving to passive, and other people are trying to let the computers do it, and that's what Jim Simons showed how the world to do that. So that's what my book is about, how the fits and starts. It wasn't an easy process, but how they figured it out.
Well, I mean, it's particularly fascinating for me because in my very first job in this industry, we were invested in a number of very high-profile hedge funds, including Medallion, and the numbers were truly extraordinary, so extraordinary that one did have to wonder if they were real. To our disappointment, we discovered in 2002 that all our capital was going to be returned and that we weren't going to be making these returns anymore. They returned all the outside capital. But the upshot of that is everyone got all their money back plus all the profits. So, Ponzi schemes tend not to be very good at giving back the profits. So,
it's a very good point because I hear all the time, it's got to be a Ponzi scheme. Yeah. And we did an excerpt for the Journal when my book came out a few Saturdays ago, and half the readers were sort of average folk, not sophisticated investors, and they were like, I don't buy it, it can't be true. And yeah, there are good reasons to believe that the returns are true. Also, the fact that after Madoff, the SEC sent people into Renaissance for 2 years that were going through it, and they didn't find anything wrong. So another reason for some reassurance.
So I'm fascinated. How did you get access to, you had, how much time did you have with Jim Simons? How did you get access to all these people, and how many people from Renaissance, former employees, did you end up getting access to?
Yeah, so it was, this is the most difficult challenge of my life, the hardest thing I ever did in my life. So I decided to write a book about the most secretive. They're not just really good, they're the most secretive firm out there. They've got these 30-page non-disclosures they make everyone sign. Simons speaks once in a while, but usually it's about science and philanthropy, and his people don't really talk. So I thought if I could somehow write the book, I know I'd be interested in learning about it, so I assumed other people might be. So how did I do it? So for months, I started talking to people who used to work there. I got some former employees to talk, but I was still not sure I could do it. And I had a check on my desk in advance from my publisher, and I'm a writer, so it's not like I needed the money. I could use the money. I got a kid in NYU, but I didn't cash the check for months because I wanted the ability to give it back to my publisher because I wasn't sure I could pull this thing off. So finally, like the accounting department at Penguin Random House, they were like, well, who doesn't cash a check? Who's a writer doesn't cash a check? So they were like, there's a little discrepancy here, what's going on? And I said, I'm still not sure I could do this thing. And finally, I got enough early people to talk, people that worked with Simons early on, and they were just fascinating, just individuals, characters, colorful mathematicians, just really interesting people. And I said, okay, I think I can do the early part of the period of the Simons and Renaissance. I'm still not sure I could do the middle and later. I needed to develop sources within the firm right now. And I didn't know how I was going to do that, but tuition was coming due, so I cashed that check. So yeah, it was sort of a leap, and I was, up nights worrying about it. But finally, and Simons told me at one point he's not talking to me. His person said we've thought about it, and Greg, we decided we're not going to talk. But then he came around later on, and we spent over 10 hours together, and I got the fumes in my face and all that. So he's a chain smoker, still is a chain smoker. So for those who don't know, so eventually I broke through. To be clear, he didn't tell me he didn't open the kimono or anything. He talked about what he wanted to talk about, and I had to get everything else I needed to write the full story of how they did it.
I mean, some of what you learned about those early years of Renaissance were really mind-blowing, the way they started and some of the things they were doing and the failures and the challenges they have. I mean, maybe talk a little bit about those early years and how do they eventually build something that became so successful?
Yeah, it's a good question. So when I started the project, I'm writing about the greatest, again, what do you call them, speculator, moneymaker in history, and I thought, all right, they figured it out pretty, and you see the returns. They've just always been amazing since I write since 1988, and pretty early on they just kind of were amazing. But the more I dug into it, the more I realized how many fits and starts they went through, how many challenges, how many setbacks, how it wasn't even clear he was going to stick with investing. And this was a guy who only started the firm around age of 40, and they made their breakthroughs he was past 50, and as late as 1988, it wasn't clear. The employees thought he might give up, and it's called Renaissance Technologies because he was doing venture capital stuff on the side, and people internally are like, I don't know if Jim really believes and they're going to succeed in terms of the trading side. So, and it wasn't clear he wanted to stick as a quant. That's the other surprise, because he's a groundbreaking mathematician. I really believe if he had never invested in the market at all, he'd still be worthy of a book, because he did really interesting stuff in mathematics. He broke Soviet code during the Cold War. He was a code breaker for the United States. What he's doing lately in terms of philanthropy and science and interesting stuff. But he's a quant. He's a mathematician. And yet, for a long time, he was investing in different ways. He was kind of being a macro kind of investor, looking at the news and guessing where economies were going. So there's a process there, and I found that process really fascinating as an investor, as a manager too, the fits and starts and the challenges, the resilience that were necessary. There are other lessons that, to me, I learned from the process and from the book writing.
Well, I mean, what comes across is that, he was a brilliant mathematician, but also a brilliant businessman, a brilliant manager of some really eccentric, rather quirky people. And I think you make the comment that they're none of your typical Wall Street guys. These are guys that are coming from other areas of academia, excellent in their particular niche, but how do you put together guys from speech recognition and this and that? Very interesting. Maybe talk a little bit about what you learned about some of the characters and how he was able to build them and keep them together and retain them.
Sure, it's a good point that in some ways it's an investing book, but it's as much a management book, because the way it was described to me internally is Jim Simon's genius is in managing genius. And that was another surprise. I thought he would have been responsible for many of the signals, if not most of them, in developing the algorithms. And he was involved, but he isn't responsible for a lot of the breakthroughs. And he won't claim that responsibility, that credit either. He's got a remarkable team. And people today talk about PhDs, how many PhDs we have on staff. Oh yeah, you give tours of firms and out there is our PhD. And yes, they have PhDs at Renaissance. They have like 90 or so out of the 300 employees. But it's not just the PhDs. These people are the tops of their fields in science. And we're talking physics, we're talking astronomy. I always have to make sure I don't say astrology. Be careful.
What's wrong? Nothing wrong with astrology.
Nothing wrong with astrology. Sure. I do not believe he hires astrologers. Sorry if I disappoint anybody. Pisces. He's really big into the Pisces now. But he hires people. When you start looking at the talent level there, and it starts from the beginning, as you suggest. Elwin Berlekamp, Jim Axe, Henry Laufer, Lenny Baum Welch. These are just acclaimed, groundbreaking mathematicians and scientists who dominated their field, and that's where he gets his talent. He looks for people who are just superstars in areas of science, and he recruits them. And how does he do that? The fascinating thing to me is these people aren't interested in investing. I mean, the big paradox of the whole book, for me, and in this remarkable story of Jim Simon's and Renaissance, is the very people that figured out investing are those that don't even care about investing. Like, I grew up reading Barron's and reading books, and Adam Smith and Graham, and the classics, and I'm into investing. I'm into Wall Street. I like the whole industry. They couldn't care less. These guys some of them don't even believe in capitalism. You got people way to the right, got people way to the left. They don't even, some of the early people I talked to, their wives were the ones investing for them. They didn't even care about investing. They don't even care about this stuff, and yet they're the ones who figured it out. It's kind of confounding to me. It's such a paradox to me anyway. So they hire scientists. And then so how does he get them? So why would a scientist go work for there? And you would say, okay, they want to make a lot of money, but it's not that, because these guys, they're not that focused on making a lot of money. Once they get there and they start making a lot of money, trust me, then they change like you and I change. And the cars change. You can see, and I read about it in the book, the parking lot changed. So don't get me wrong, they do like making a lot of money. But that's not why they joined there. They joined there because Jim Simons, he doesn't run it day to day anymore, but this same ethos, and this is how he did it. He presents a challenge to them. And these are super bright, super competitive scientists who, and I learned about that world in mathematics, and there's an insecurity there, and there's a competition. They're much more competitive than I would have thought. And he often does the same thing. It's fascinating. He says, these people turn him down, colleagues in the business, and he says, just come for a day, come 1 day a week, come work for me 1 day a week. And he's a nice guy, and they like him, he's personal, so they come 1 day a week, and then they get into it, and there's a challenge. How do you beat the market? I mean, you want a challenge, what a great challenge. How do you beat the stock market and other markets as well? So he hires non-financial people. He doesn't hire from Wall Street, and the beauty of that is that And I can talk about internally how they manage things. We can come back to it. It's a whole unique way. The transparency internally. There's no transparency outside, but internally they cooperate. They're collegial more than any other place. But they share information more than any other firm I'm aware of. And the risk there is, okay, everybody's familiar with what everyone else is doing. Can't you just go and leave? But the beauty of hiring from non-Wall Street is that these people are going to, when they make their money, first of all, they make so much money they don't really need to go to another firm afterwards. But even those that want to leave, they're not going to go work for another firm. You've worked at Medallion. Why do you need to go work anywhere else? You make your money and then you go back to science or you go philanthropy. So it's a fascinating model. I'm not sure he consciously developed it that way, but he just hires super smart scientists and presents them with the challenge. And he also hires, I'm jumping around a little bit, but he doesn't hire for need. He does, I don't know if people are sports people here, but best talent available kind of position. He doesn't look for need, he just hires the best people and he says, you'll figure out some way to contribute. So it's an interesting approach. Not every firm can do it, but.
Yeah, no, I mean, in the book you talk about Medallion as a retention tool. So you get these brilliant people in, and I mentioned at the beginning, all the outside investors were booted out, and it's internal capital only. If you're compounding your money at those sorts of rates, it's a powerful retention tool.
Yeah.
And you leave, you lose it. So it's a tremendous. You touched on paradoxes. I thought one of the interesting things was also the paradoxes of some of the people there. We joke about astrology, but some of the people working there have beliefs that make astrology look like a pretty solid science.
Are you thinking about Mercer in particular? Is that
I didn't say Mercer, but certainly some very interesting characters mentioned. Maybe touch on Robert Mercer.
Sure.
I think he's just managing that sort of personality in an organization with people with very differing views. I mean, that's a real skill.
Yeah. So I assume many people in this room who knows he is, but not everybody. Bob Mercer, one can argue, is more responsible than anyone else for putting Donald Trump in office. So Bob Mercer is was co-CEO of the firm until a couple of years ago. He is responsible. He and Peter Brown are responsible for some of the most important breakthroughs within the firm. So until 2004, Renaissance was a pretty sizable firm. They managed about $800 million, but they were only in commodities, currencies, bond futures. They couldn't figure out equities. And they were making a lot of money, and that was enough for most of the people within the firm, but not for Jim Simons. He wanted to be a billionaire. Jim Simons is a mathematician and a scientist, but he loves money. So he wanted to get really, really wealthy, and you couldn't do that unless you grew the firm, and you couldn't grow the firm unless you could figure out equities. And I write about the breakthrough and how they turned it, and they figured it out. And Bob Mercer is one of the key reasons why they were able to. So he rose within the ranks, and is very important within the firm, and he's also one of the more unusual people out there. He doesn't speak very much within the firm. He's an odd, unusual guy, and he developed these unusual beliefs as well, pseudoscience kind of outside the firm, I think is what you're suggesting. Things like, I don't know, nuclear wars aren't that bad. Nuclear
climate change isn't real.
He doesn't believe in climate change, and he became a very right-wing guy. Well, he is a right-wing guy, but he became very active in conservative politics. So he and his daughter increasingly became active and increasingly wanted to support someone out beyond the mainstream. At first they supported Ted Cruz, and then they switched their allegiance after Cruz left the campaign in 2016 to support Donald Trump. And they're the ones, so they got involved with things like Breitbart and some other causes on the far right, and they're the ones who put Steve Bannon and Kellyanne Conway in the Trump campaign. And it's easy to forget, but it was floundering at that time, sort of the summer of 2016, and Rebecca Mercer, and I'll write about it in the book, sort of went to Trump and said, you got to put these two people in your campaign. And to their credit, you may not be the biggest fans of Steve Bannon and Kellyanne Conway, or you may be their biggest fans, but they really steadied that campaign and really turned things around. So Bob Mercer, so it's interesting because Jim Simons himself is a left-leaning guy, as are a lot of people within the firm. But Bob Mercer is a right-leaning person, and yet they work together really well. But yeah, it's a book packed with what I find interesting, unusual characters, very colorful, more so than I had expected when I started the research.
So I mean, they were never going to, Jim was never going to give you the secret sauce. You were never going to get that. But were you able to glean whether or not, they have some, really unique insight into the way markets function that really no one else has grasped, and how paranoid are they that they may lose that edge, that edge could evaporate very quickly if someone else is to discover this thing, or is it really lots of different things and something that's very hard for someone to kind of figure out and penetrate? It isn't like it isn't one equation that solves the market, it's multiple equations.
So he wouldn't talk to me for a long time, and Bob Mercer didn't talk to me, Peter Brown didn't talk to me, and part of the reason is as much money as they've made, they are, I don't know if you call it paranoid, they're worried that people are going to catch up and that secrets are going to slip out. Now, in my book, I talk about a lot of advantages they have. I don't think there's any one secret that, and I kind of expected it maybe when I started the research. Okay, every Wednesday at 3:30, retail stocks always go out, or something like that. And it's not like that, but they are better than everyone else at a lot of different things, and I can talk about some of them.
I'd be very interested to hear about some of the things you think that they're better at.
Sure. So, early on, they were the first ones really to collect data before people really cared, and I talk about that process, and not just collecting, cleaning it. And broadly speaking, Jim values all kinds of steps along the way that maybe not everyone does. Cleaning data at the time, now it seems important and obvious, but they emphasize that before anyone else. They have data that goes back to like the 1700s, and today it's not as much of an advantage or as valuable as it was maybe like 5-10 years ago and earlier than that. For a long time they'll give them a huge advantage because they're all about, so what do? They look for patterns. They look for patterns that repeat, short-term patterns that repeat. They're not high-frequency traders, flash boys, that kind of stuff. They don't get in a millisecond before you and I do, but they look for kind of moments to months, is what they say, but it's basically a few day patterns kind of thing in the market, and they do the best in, as we discussed earlier, turns in the market, crises in the market. Why? Because their thesis is that human behavior repeats, and by having data that goes back centuries, literally, they can find, they can map out how our behavior will repeat as traders and investors. So they do a better job collecting data, cleaning data. They do a better job in figuring out their impact on the market, what they call slippage, and I talk about that process, and there are a lot of not so obviously sexy steps along the way which they spend a lot of time focusing on. They analyze the data in different ways. People subsequently start doing what they do, but they have different blocks. They figure out 5-minute blocks. They compare blocks within the day. It's all in the book. They have a lot of different steps, so I didn't find any kind of one huge secret that no one else knows, and they have better talent than everyone else. They hire. They worried more about like Google and Facebook competing with them than they do Goldman Sachs and Two Sigma. So there are a lot of, they emphasize a lot of different steps along the way, and in putting how to put on the trade, how to hide their signals. I talk about that a little bit. They try to find, there are things they do so that they don't, they're not obvious in trading, in finding their opportunities. There are a lot of different secrets along the way, but there's no one huge secret. It's a lot of different things that add up into this remarkable institution, machine.
Did you go on site to the Long Island, the main Long Island?
I did not. They wouldn't let me in.
You could pretend to be an investment manager,
Security was not buying that. They got heavy security outside. I was there. When I met with Jim, it was in his New York City office. He does now. He does more foundation and philanthropy work. So we had a complex relationship. We still have a complex relationship, Jim and I. He was very kind and generous with his time in talking about things he wanted to talk about. So he was very clear about not wanting to tell me anything about Renaissance, and for a long time he wouldn't talk to me in general. Then I kind of wore him down to some extent, and again, I'm very appreciative, but yeah, it was also just for me, I'm not a math guy, so my publisher was betting, and I kind of did it with my last book I wrote about the energy industry, the Frackers, and I didn't know anything about science and fracking. And so the bet my publisher made, and that I kind of make, I guess, is that as an outsider, if I can figure out what these people are doing, then I'm hopefully in a good position to explain it to the masses, both sophisticated people like people in this room, but you want to be on the bestseller list, you want to write for everyone. So the challenge for me is I'm not a math person, I'm not a quant, and I had to understand that world. And it was just, it was ridiculously hard. So I'm going to read, I brought this up here, I just want to read this for people, give people a sense. So at some point, Jim did start being more cooperative and helpful, and especially about some of his early work in mathematics, which again is fascinating. And he built a department at Stony Brook. He taught at some interesting places, and he was a code breaker. So I got stuck on this word holonomy. Does anybody raise your hand in this room if you know what holonomy is? Don't be embarrassed. I'll be proud. All right. No. So good. So at one point I had trouble. It's a mathematical concept. So I asked him, and he taught. So he's one of the few people that he could do the math and the science. He's a quant, but he also is a funny, really witty, interesting person you want to have a beer with. So he's very well equipped to explain. And he was a teacher, so he could explain stuff to me. So this just gives you a sense for the challenge I had. So I said, can you dumb it down for me? Just explain what holonomy means. And there'll be paragraphs in the book. I assume you'll read it at some point, or you'll give it to someone, whatever. But it won't look like I put that much work into them. But I literally spent months on some small sections about some of the early math and what he did, and because I had to understand it myself, then be able to explain it. So again, there's this word holonomy. So I said, "Can you explain it?" He said, "Sure." So he goes, "This is his email. I'm reading from verbatim from an email to me. If it is helpful, holonomy may be defined as parallel transport of tangent vectors around closed curves in multiple dimensional curved spaces." So he was a geometer. So this is him dumbing it down. I don't know how many people are fans of The Office. You know the TV show The Office, where there's a scene where Michael Scott's saying to his employees, pretend I'm an 8-year-old, and then he explains it, and then he goes, all right, pretend I'm a 3-year-old. And that's how I felt half the time. And then these mathematicians, I don't know any mathematicians in this room, and I don't want to insult any of them. They're a very unique breed. So I would spend literally weeks in my basement putting together like 3 paragraphs about some of the stuff, and I would send it to them to make sure I didn't make a mistake. And I'd get these calls back or emails, "Greg, you've butchered this thing. It's all wrong. How dare you? You should be writing this book." And I was like, wow. And then we dig into it, and basically like 10% of it was wrong, 15% of it was wrong, and that's sort of why I sent it to them, to make sure it was, to find out what the mistakes were. But they hate errors, they hate mistakes, it gets under their skin. And that's part of the reason why he didn't want me writing this book also. And a lot of people talked to me, and they were worried about the end product. I think some of them have emailed me subsequently, they were happy with it, others I haven't heard from, so who knows. Yeah, it was a challenge, it was a tough process.
Talking about error, there's an incredible error that you describe in the book, one that you just can't believe that an organization such as Renaissance could possibly make. This is an error in the equity code.
Yeah, right. So I'll talk about it in a second, but I think one of the lessons is like even Renaissance makes stupid mistakes.
Really stupid mistakes.
And there were a few in the book. So early on, they cornered the market for Maine potatoes by accident. That was really early on. That was like in 1984.
By accident? How did you do that by accident?
And then Simon's got a call from a regulator, and they're like, dude, this isn't right. You cornered the market on potatoes. And he thought they'd understand that his machine was really early. It was very crude and early sort of machine learning. It was buying stuff without them realizing why they were doing it or even what they were doing. But they didn't see the humor in it, and they made them close out the positions, and they lost money. There were a lot of, that goes back to the fits and starts. And then with equities, they spent years trying to get equities right. And I write about it in the book. There's a guy named David Margaman who was a relatively young individual within the firm who later became very controversial. Spoke out about Mercer and such, but he found there was an error, and I think there was a number that was static and it wasn't updating. I think they were using an S&P 500 figure from years earlier, and it hadn't been updated. And this is some of the top guys in science and mathematics, and he brought it to the attention of Bob Mercer, and to his credit, Mercer was like, "Oh yeah, no, I got that wrong," or something, and they changed it, and they were off to the races. They became the greatest investment firm because of, I mean, who knows? Maybe someone else would have found the mistake, but It does. It's sort of humbling or reassuring, maybe. You know, even these guys made, and they're super duper smart. I mean, I can't even come close, but they make dumb mistakes too.
Well, and now they have the tens of billions of dollars in equity products, which are open for outside investors, which have done and continue to do tremendously well. So it's probably a good thing that somebody found that mistake.
Yes. Yes.
I'm sure that people have questions here in the audience. Can we open it up to questions? Don't be shy. We're a small group here.
Yeah, sure. Is there like a sense in the firm or Jim or the people broadly of like the social responsibility component of like these are the best minds from things that could be applied to especially since Medallion's only for them. It's like a very strange like brain drain situation. Yeah. Like, do they care, not care? They're just kind of in their problem solving playground and it's really fun. And then, as you said, they leave maybe 10 years later and go back to academia. Or just curious about that.
It's a really good question and a good point because I struggle with it myself because I spent a lot of time in my life focusing on individuals. They're not even just traders, and you can say, well, do traders add value to society or not? They're improving liquidity. Yeah, but do you need so many smart people doing that? They're not even doing that. They're not even. You could say, okay, I'm making money. I'm a fiduciary. I've got LPs. There aren't LPs, at least for Medallion. They're making money for themselves, and it's a brain drain. So Jim Simons is a really interesting guy, and he's very philanthropic. He subsidizes the top, I think, 10,000 math and science teachers in New York, public school teachers in New York City and New York State. Wow. Because he doesn't want them leaving to go join firms like Renaissance. And it's not a sense of guilt, and I pointed it out to him. I'm not even sure he focused on that irony. He's like, it's not right, math teachers shouldn't be leaving, we should give them more money, which is completely accurate, and yet he's one of the, I did say that to him, he's like, well, they'd be leaving anyway if it wasn't for it, which is true. So to get to your question, I do not think people internally, well, okay, some people, a minority of people do worry about that stuff, that are they adding to net positive for society? Are they drawing brains out? And I've said that to Jim, and he kind of said, well, the talent they've got there, while great, there aren't so many individuals that it's affecting any one area of science and math. And to be sure, they're very philanthropic, and they do really interesting work when they leave, and sometimes they make so much money that they can go off and do, and I'm not even talking about politics, so you can agree with Bob Mercer or Jim Simons, who is one of Hillary Clinton's biggest supporters, or I'm not talking about politics, I'm talking about real philanthropy and doing really interesting things out in Africa, some of the people there. Simons is at the forefront of autism research, and he's the biggest funder of basic science right now, and hiring real scientists to do the blocking and tackling that isn't being funded by government today. So I have mixed feelings myself about these people. You could argue that, had they stayed in academia, they would have made incremental progress, but they spend 5-10 years at Renaissance, make a lot of money, they can do even more things. Or you could say, there's just another hedge fund guys that aren't adding anything to society. I'm not sure myself.
Other questions for Greg?
I think over here.
There's one there. Yeah.
What's the relationship between Robert Mercer and Jim nowadays? And I'm just like, is he involved in the firm? Does he still have ownership? Does he have money in the funds? Would Mercer ever start his own fund?
He would never start his own firm, no. Because these people they're scientists, they just like the work. They're not fundraisers. I mean, a few of them have left. Many don't do that kind of. They're just cut from a different cloth. They're different personalities. So you asked about the relationship, and I think you asked because, so basically Bob Mercer was this right-wing guy within the firm, and for a long time he was sort of seen as just sort of this curiosity within the firm. People at first didn't really know his politics. People haven't read the book yet, but you'll see over time he started torturing left-leaning people internally in terms of just teasing them a lot. He would get into fights with them, not angry kind of fights, but he would zing them like in the lunchroom. And he was getting more senior within the firm, so some of them didn't feel comfortable pushing back, some did, so there's tension within the firm. So tension was growing, but for a while he was just seen as an odd guy. He didn't really talk too much. He supported some weird causes. There's some scientist out in Oregon who was collecting urine and analyzing urine, stuff like that. And maybe there's some scientific benefit of that, I don't know. And then, but then people are like, wait, hold on a second. Come 2016, when he got behind, and he didn't, it wasn't just Trump, he did other kind of causes. He was behind the effort to push back against the mosque near 9/11, Breitbart, Brexit. He got involved with a lot of things. And for a while, Simons, to answer your question, Simons and others sort of were torn because they didn't agree with his politics, but they liked him, especially Simons. Simons is, again, an interesting guy. He's a scientist and mathematician, but he loves money. And Bob Mercer was helping him make a lot of money. I mean, Jim Simons literally makes $1.5 billion a year without going into the office. It's a crazy thing from his equity in the firm. Maybe he'll go in for like to chair or some meeting, whatever, once a year. So here's this guy, and he works, Bob Mercer for years was working as CEO, co-CEO with a guy named Peter Braun, and they worked well together. And the firm did amazing work, and you could even argue they're more important together than Simons in terms of not managing, but finding the actual algorithms and developing the. It's an engineering marvel. In any case, so Simons was torn what to do, and people internally were starting to grumble more. And eventually, and I write about it in the book, Simons had to go to Mercer and say, "You've got to step down," because morale was getting impacted. They were losing. There were a couple individuals I write about who either were going to leave or thinking about leaving, and they were worried about hiring, being able to hire individuals from the outside, top people. So eventually he stepped down, but he didn't leave the firm. So he's still at the firm, and he's still like a researcher. There are a lot of researchers at the firm, and he isn't, like, people kind of on the outside, I thought, okay, he's not CEO anymore, but he's still going to be doing the same thing. He's still there, but no, he's not leading the firm, but he's doing research. They find problems. And you say, well, the returns are so good, and they're still so good. Don't they just sit back and let the machine work? But the market is always changing, and I've posed the question internally to people, my sources in the firm. Well, the market, there are more passive investors than ever. There are fewer dentists as they joke, to take advantage of. Does that mean there are more challenges for the firm? And they say, yeah, and that's why there's always a new challenge for them to keep adjusting. So guys like Mercer, that's what they're doing.
Well, I also read somewhere that Mercer has the biggest private machine gun collection in the world. So that, you don't fire that guy, whatever he does.
For the record, let's not suggest that he would use those machine guns.
Of course not. Of course not.
Just like looking.
One of the things you touched on is just the discipline of capacity in Medallion. So, maybe talk about that and how the discipline around that, and just the understanding, the real appreciation that maybe a lot of people just haven't demonstrated in the industry.
It's a really good point. So I wrote an earlier book called The Greatest Trade Ever, and it's about John Paulson and other people who anticipated the financial meltdown. And Paulson made $20 billion over 2 years, and then changed the way he invested. So he used to bet on investments that had a huge upside, and this is even before the subprime trade, even when he was a merger arb, but had limited downside, and that was his whole MO, and he got away from that, and AUM soared. He was I think at one point he got to like 36, maybe $38 billion of AUM, and like everybody else, he said, oh, I'm going to be the exception. I'm going to be able to manage a lot of capital and still outperform. And he didn't, and he got into you get into other types of investing, and bank stocks and pharma, etc. So I give Simons a lot of credit. They kept Medallion capped, and for a while it was $5 billion, and now it's $10 billion. And the knock on him or my book, you could argue as well. Buffett manages whatever at least the market cap of Berkshire Hathaway is like whatever, 300 billion, 400 billion, whereas Medallion is capped at $10 billion. How do you compare the two? And I would argue, well, first of all, Medallion doesn't leverage up, so it has over 100 billion in investments, but also that was a conscious decision. Buffett didn't have to. He's underperformed for over a decade. He got too big, as did Paulson, as it did most. And to their credit, Simons they kept it capped, and they kicked out non-employees, even family members, even friends were kicked out, and they were pretty unhappy because some of them were there with Simons from the beginning and when things weren't going so well. But yeah, I give them credit. They did start these other funds, outside funds, Reef and Ridge, but and you read in the book, that wasn't really it's to make money, obviously, but Simons was going through some personal stuff in his life, some tragedy, and I argue in the book he needed a distraction, and he also needed to keep his scientists. Needed to give them new challenges. So he needed to keep recruiting top scientists. So that's why I would argue they started these outside funds. So, but in terms of Medallion, yeah, they've capped it at $10 billion.
Well, they have $11 billion of their own capital in these new funds, internal capital.
Yeah, that's true.
So,
that's true.
That's do you think the organization, how will it survive once, Jim Simons is no longer at the helm? I mean, he's been so instrumental in keeping it together and keeping these interesting characters from killing each other. Do you think the firm will be challenged after he's no longer involved? Or?
Yeah, because he's not really involved much anymore. He does mostly philanthropy and science and
Right.
Math for America and really interesting new challenges. But I do think how can they keep these returns going? I mean, he seems unlikely, and people internally aren't arrogant. They're aware. There are more people doing what they do than ever before. I mean, people in this room, I'm sure, are aware. Quant. We in the media say Quant. It means a lot of different things. You've got your factor guys and more passive type people. Cliff Astis. What Jim Simons does actually, or what his firm does, is somewhat unique in terms of they're not high frequency. They're not They include factor stuff, whatever. But maybe Two Sigma does a little bit like them. D. Shaw. Pete Muller, but there aren't that many people that do it like he does. But yeah, you got to figure you can't. It's hard to get those kind of crazy returns every year. But even this year, they've done a little bit better than the S&P 500. So they haven't destroyed the S&P 500, but my sources say they're still doing fine. And it's not just the returns. I don't emphasize that enough. I think, but it's the Sharpe ratio. People in this room would appreciate.
It's the correlation. As someone who saw the monthly numbers for years, I mean, it's at turning points where most things do badly, they sell.
It's correlation. It's also just kind of steady. It's crazy. The Sharpe ratio is just as impressive as the returns.
Absolutely. I think we have time for one last question.
So when you were in the fund and getting monthly reports, did you actually see the trades he was doing?
Absolutely not. No. We got a fax. This is before. I'm not joking. It was a fax. You got a fax with. Yeah, this is your NAV. This is you got a fax. Yeah.
They don't give any of that out.
None of that.
They don't. They're very secretive for their own LPs as well. And they became sort of something funny to say about fax. They became very kind of low tech. Like you had to call a phone number at one point early on to get returns because they want to go the other way and not share anything.
Okay, great. Greg, thank you very much. It's been a real
Nice meeting you.
pleasure. Thank you. Thank you everyone for coming. I think that's a wrap for the conference. Please join us for drinks and for book signing with Greg's book. Thank you.
I'll be signing books if you
Yes,
want.
come and get a book and have a signed copy.